Have you ever considered what it truly means for a company to be a fully integrated player, especially in a really specialized global industry like fluorochemicals?
Yeah, it's a term that gets thrown
All
around.
right,
But what does it actually look like on the ground?
exactly. How does that level of control, that foresight, play out day to day or maybe quarter by quarter?
Mm-hmm.
Well, today we're going to dive deep into exactly that. We're looking at the recent Q1 FY26 earnings call of Stallion India Fluorochemicals Ltd.
Okay.
And this deep dive is really for you if you want to quickly get a handle on their main business segments, understand some critical shifts happening in the fluorochemicals industry,
Which are definitely
to
happening.
see the company's pretty ambitious future plans, and also identify the key risks they're, well, trying to navigate.
And I think what's really fascinating here is seeing how a company's long-term vision, something built over like 30 years, they said,
30 years, yeah.
how that actually filters down into the decisions they make every quarter. We're trying to get beyond just the headline numbers.
Right, digging into the why behind it all. So let's start with a snapshot of where they are right now, their current business.
Okay.
Stallion India just reported their Q1 FY26 results. And they look quite robust, actually. Revenues hit 110.55 crores.
Which is what, about 1.1 billion rupees, roughly 13 million US dollars?
Yeah, around that mark. And that's a big jump, 50.3% year-on-year increase.
Wow.
And their profit after tax, P8, that was up over 21%, 21.47% to 10.36 crores.
That's solid growth.
It really is. And what caught my eye on the call was they stressed this is usually a seasonally softer quarter for them.
Right. Q1 and Q2 are typically weaker than Q3, Q4 stronger.
Exactly. So to pull off that kind of growth in a normally slower period, well, it says something about their operations.
That seasonal context is definitely key. And, looking at their products, there's a built-in flexibility there. About 60% are what they call multi-use.
Multi-use, meaning?
Meaning they're not just for one thing, they serve different segments. Refrigerants for air conditioners, firefighting chemicals, aerosol propellants, blowing agents for foam insulation, that kind of thing.
Okay, so not just niche products.
Well, they have some of those too, like
Yeah.
SF6 gas for the power grid that's pre-specialized. But the bulk is broader. And they made a point that all their locations across India can handle all the products. Gives them agility.
That sounds incredibly adaptive. So
Yeah.
right now, their value chain, they import the basic molecules in these big containers, ISO tanks.
Yeah, bulk import.
And then they process them and distribute them out. But here's the detail that jumped out. Stallion is apparently the only company in India that's fully forward integrated.
And what does that mean in practice?
It means they handle everything from the processing, the blending, the packing, right through to the final distribution across India themselves. No third parties for those last crucial steps.
Okay. End-to-end control on the output side. That is a significant advantage.
How big, really?
Well, think about it. It gives them consistency, speed.
Yeah.
And it ties into something else they highlight, their inventory management. This might be their, secret sauce, perhaps.
Go on.
They intentionally carry high inventory, like 100 crores worth back in March. Now, normally high inventory is bad news, right? Ties up cash.
Yeah, risk of obsolescence, storage costs.
Exactly. But Stallion sees it as a strategic asset, a buffer. It guarantees supply reliability, which is huge for customers, and it lets them fight back against the crazy price volatility in this market.
Volatility from what?
Oh, you name it. Geopolitics, messing with shipping lanes like the South China Sea, weird weather events, dollar fluctuations, freight costs, suddenly jumping from, say, $2,000 to $10,000 a container.
Wow.
So holding inventory lets them ride that out. And sometimes, like they mentioned, if market prices jump 25%, they benefit directly because they bought their stock cheaper earlier.
That's turning a risk on its head. Clever. And this reliability thing, it seems core to their identity. They talked about a 30-year track record.
Never failed a supply commitment, they said.
Never. Even stepped in to cover basically 100% of India's requirement during shortages in 2005, 2010, 2017, even 2021.
That kind of history must make onboarding with big customers, OEMs, much easier.
Definitely. They said qualification often just needs lab testing, not the full, lengthy audits you'd need for an unknown supplier.
Makes sense. And this probably helps with pricing, too. They mentioned different model spot pricing for the general aftermarket.
Which is the bulk of the market, right?
Right. And then contracts annual, quarterly. even monthly for the OEMs.
Yeah.
And in today's world, those shorter monthly or quarterly contracts are way better for managing volatility.
Okay, so that's a good picture of the current setup. Let's zoom out a bit now. The industry dynamics, where things are heading.
Yeah, the bigger picture.
Stallion is clearly aiming at what they call high-growth markets. They specifically mention semiconductors, solar, fiber optics, advanced cooling.
Things projected for strong double-digit growth, KGRs, over the next decade. Big opportunities there.
Absolutely. And central to this seems to be the whole refrigerant landscape, which is changing fast.
Oh, massively. This is crucial. So India already makes plenty of R32 refrigerant, maybe even too much capacity right now.
Okay.
But, and here's where it gets really interesting, the industry is shifting away from R32. Its global warming potential, GWP, is around 600. Not great.
So what's replacing it?
These new HFO blends, hydrofluorphins, for air conditioners, think R454B, its GWP is half that of R32, around 300, much better.
HFO blends. Okay.
And similarly, another common one, R134A, huge usage, over 10,000 tons a year, that's being replaced by HFO blends too, like R513A.
Got it. Greener alternative.
Greener, yes. But here's the kicker. These new HFO blends, they still contain a lot of R32, like 50–60%.
Ah, so that's why Stallion is building that R32 plant we'll talk about later. Backward integration.
Exactly. They're securing the key ingredient for the next generation of refrigerants. It's about future-proofing their supply chain for these advanced blends.
Smart. And these gases, they're not just for standard ACs, are they?
Not at all. Super diverse uses. Take SF6. Yes, electrical substations, but higher purity versions are vital for plasma etching of silicon wafers in chip making.
Semiconductor manufacturing.
Right. And it even has niche medical uses, believe it or not, in eye surgery. And those HFOs. Critical for cooling big data centers, complex semiconductor equipment, all booming in India.
Which ties back to those high-growth markets they're targeting.
Precisely. And Stallion has a real edge here with HFOs.
Yeah.
These are heavily patented products. Only 2 companies are currently authorized to sell them in India, Chemours and Honeywell.
And Stallion works with Honeywell.
Yes, a 20-year relationship. That gives them a massive first-mover advantage. They've already sold over 400 tons. It's a big barrier for anyone else trying to get in.
That sounds like a strong competitive moat. Now, what about the elephant in the room? China dependency? That comes up everywhere.
It does, and they addressed it directly. Look, the reality is many basic chemicals and minerals like fluorspar, which is key here, they originate in China. That's just history, scale, government support there.
So even if you buy from the U.S.?
The raw material might still trace back to China. They were quite open about that.
Okay.
But connecting this to geopolitics, India's stance is shifting, right?
Yeah.
More Asia first, recognizing it's complex. No permanent friends, no permanent enemies.
So Stallion's plan for local manufacturing isn't just about avoiding China.
Not solely, no. It's broader. It's about reducing overall import dependency, building resilience, sourcing locally where possible, aligning with India's push for self-reliance. Makes strategic sense.
Okay, that leads us nicely into their future plans. Their master plan. They're very clear. They want to become a fully integrated fluorochemical player.
And they frame this not as some new idea, but as the result of, 30 years of planning, waiting, experience, and knowledge.
Right, and their IPO, purely for growth capital to make this happen.
Yeah, they're putting serious money behind it. That new R32 plant in Bhilwara, Rajasthan, that's a big piece.
Tell us about that.
Okay, so MOU signed. Investment is 120 crores mentioned in the MOU, but that's mostly plant and machinery. The total project cost, they clarified, is over 200 crores, excluding land, building, working capital.
Okay, significant investment. Capacity.
10,000 tons eventually. They'll start with 5,000 tons, then scale up. Pretty standard approach in the industry.
And not just R32.
No, it'll also make about 8 other advanced blends. Things like 410A, 404A, 454P gases needed for newer systems.
And the why behind this plant? You touched on it.
Yeah, multiple reasons. 1, captive need. They currently import 2,000, 3,000 tons of R32 themselves. This plant covers that.
Okay.
2, it completes the backward integration loop. They're already forward integrated, now they'll be backward integrated too. Makes them pretty unique.
Full vertical integration.
Exactly. And 3, most importantly maybe, it secures that R32 supply needed for the growing HFO blend market we just talked about. Future-proofing.
Makes sense. Timeline.
Land acquired. They're aiming for construction and production by mid-2026.
And the financial impact.
They expect about 135 crores in turnover just from the first phase. And a big jump in profitability for that segment, manufacturing PAT, projected over 24%. That should lift the whole company's margins.
Okay, big plans in Rajasthan. What about their other facilities, Mumbatu in Andhra Pradesh?
Right, that was initially planned for HFOs and specialty gases. Now, double the capacity, they said, 10 tanks instead of 5. And they've enhanced it to handle hydrocarbons too.
Hydrocarbons are important for...
Yeah, they're used in some newer refrigerant blends and other applications. Plus, Mumbatu will now also have a semiconductor facility added, so the whole project there has basically doubled in scale and scope. Bigger ambitions.
And Kalapur, that was for semiconductor gases and liquid helium.
Yep. Civil work, metal structure done, equipment ordered. They mentioned a delay here, but it actually turned into an advantage.
How so?
While the industry standard for gas cylinders shifted, a big competitor, Lind, pushed toward 300 bar cylinders instead of the older 200 bar.
Holding more gas.
Yes, exactly. 10, 11 cubic meters versus 7. So Stallion had to re-engineer, which caused a slight delay. But now they launch with the absolute latest tech. They said it makes them next to the best and biggest right out of the gate. Half their cylinder investment is now for these 300 bar ones.
Turning a challenge into an upgrade. Timeline for Kalapur and Mumbatu.
Despite early monsoons hitting construction and that re-engineering work, they expect Kalapur operational by November end, Mumbatu maybe December this year. Still quite aggressive.
So putting all this together, what's the overall growth picture look like? It sounds incredibly ambitious.
It is ambitious. They're confident they can maintain targeted 30-35% growth for the next 3 years.
Year on year.
Year on year. And lift overall profitability by 334 percentage points. That pushes average PT up towards 17-18% from the current 10%.
Significant margin improvement.
Very. And their internal, longer-term target. Cross 2,500 crores turnover by FY29 or 2030.
That's more than double where they are now. Implies huge growth.
It implies growth in multiples, as they put it, driven by more, even larger manufacturing plants after this first R32 facility, which they call the smallest of them.
Okay, the obvious question, funding all this.
Right. They've got approvals lined up for up to 500 crores. They aimed high for flexibility. Current CapEx is covered by internal funds, they said.
But for the bigger future projects?
They'll need external funds, debt or equity, the usual routes. But they mentioned a really interesting alternative, getting funding directly from customers, big OEMs. Apparently, some are interested in putting money into the projects, and then Stallion pays it back, amortizes it over time through supply agreements or similar.
Customer financing, essentially.
Yeah. Could be faster, more stable than just relying on banks or the market. A very interesting potential route.
Definitely something to watch. Okay, but no plan like this comes without risks, right? They must face hurdles.
Absolutely.
Yeah.
And they were pretty open about Q1 being tough due to external factors beyond just seasonality. They mentioned geopolitical tensions, specifically a border issue in April, causing an industry standstill. That hit projects needing gases like SF6 in those regions.
Okay, unexpected disruption.
And then early monsoons in May. Just washed out the entire season, as they put it. Hurt demand.
So how did that impact their approach in Q1?
It meant they had to focus more on just getting turnover, pushing volume in a dull market, rather than maximizing the PAT percentage for that specific quarter. A pragmatic choice.
Right, adapting to conditions.
But despite those hits, they kept stressing, never failed in any commitment. And their project timelines, even with delays like weather or the cylinder re-engineering, are still way faster than industry norms. Like 12 months for things that usually take 16 or more.
So they seem adept at managing execution risk.
It appears so. They seem to build in buffers or just work faster. It reflects their management philosophy too.
Don't you?
They describe themselves as very prudent on how we spend money, careful to downplay what we commit, and just single-mindedly working towards the growth plan.
Not hyping things up.
It seems not. They believe the market will eventually recognize consistent performance and professional growth rather than needing constant promotion.
A long-term view.
Exactly. They said the big numbers, like the 2,500 crore target, aren't just figures they're throwing around. It's a clear goalpost for the whole team, something tangible to aim for over the next 5 years.
It's about disciplined execution towards that integrated vision.
Precisely.
Well, that was quite a journey we just took, from digging into a solid Q1 performance right through their strategy for backward integration, their role in these next-gen gases, and those really ambitious growth plans.
Yeah, they're clearly not just sitting back and reacting. They seem to be actively trying to shape where the industry goes, at least in India.
It certainly seems that way. Fully integrated, future-focused.
You know, it leaves you with a thought, doesn't it? As global supply chains keep shifting and everyone's pushing for greener solutions and more robust local manufacturing, How will companies like Stallion, the ones that really master both deep integration and proven reliability, how will they redefine what competitive advantage even looks like in the next decade?
That is a great question to ponder. How resilience and integration become the new benchmark.
Something to think about.
Definitely. Well, thank you for joining us on this deep dive. We hope you found it insightful. Keep exploring, keep connecting those dots.
And we'll catch you next time.